Well, it's a very sensitive subject, doing business valuation work for divorce engagements, because you have two different dynamics. You have many times this is the biggest asset that a family has, is their privately owned business, and they've put all their resources, or most of their resources and funds and money over the years. They've got that, and most of their net worth is tied up in that privately held business. And then there's just the emotional side of it as well. In the divorce engagements, there's really not any standard law across state law or federal law. It's all locally dictated, and what you'll have is, different jurisdictions might not even have a statutory law. It'll just be come down and you have to study the case law, what judge is going to be hearing the case, and that really kind of impacts it directly. So we have to do a lot of homework on the front end, a lot of research to see kind of what the history is on the case law standpoint. But really, the standard of value, there's three prominent standards now that are used across the country. And the first one's fair market value, which is used for a lot of different valuation purposes. But really, fair market values, you have a willing buyer and a willing seller, where neither is under any compulsion to buy or sell. We also have investment value, which on that one, it's just assumed that there won't be a sale, that the existing owner of the company is going to continue to own the company. So that changes the dynamics quite a bit. And then the third standard is the fair value, which is really becoming more and more popular. And one of the main conditions of that is there's not going to be, usually not going to be a marketability discount or a controlled discount, lack of marketability, lack of controlled discount when you're using the fair value standard. And that has a real dramatic impact on the valuation. There's really three standard methods that we're going to consider each time we do a valuation, whether it's a divorce valuation or mergers and acquisitions or gift and estate. And the first one is the asset approach. And that basically we get the fair market value of all the assets and the liabilities. The second one is the income approach, and we'll look at usually like a discounted cash flow method. We'll look at some cash flow projections next 3, 4, or 5 years, and we'll discount those back to the present based on the risk involved with those cash flows. Then the market approach is the third approach we use, and it looks for either comparable companies that are operating in a public arena, public companies, where we can look at some of their multiples, what they're trading at based on either their cash flows or their earnings now. Enterprise goodwill is a marital asset and is considered in the estate, whereas the personal goodwill is not a marital asset. There's a lot of different case law now and some different components of how you determine that. And one of the things that we'll consider is, if you get a call for a new business, as an example, if you're working for a national accounting firm, and if you're getting that call, are they calling you as a CPA, or are they calling somebody who works for Carr, Riggs and Ingram would be a great example of that.